Howdy everyone, Greg Martin, the Entrepreneur's Banker here. And it's been a while since I've done some videos, but for the next quarter, I'm gonna try something a little bit different. I'm gonna try and think more like an entrepreneur, less like a banker, and I'm actually gonna try and create more content through videos. If you like what you hear, give me a thumbs up, give me a like. If you've got any ideas about what you want, the topics or what you want me to cover, I'd love to hear that too. Anything that we do to connect, anything that I can do to bring more value and greater content to you and to help you as the entrepreneur push your business forward, that's my goal. So here it goes. The first video I thought that we would talk about, I actually had a discussion with an entrepreneur about a week or so ago, and that's what kind of brought this on. And I was talking to this entrepreneur, I was looking at a loan deal for her and her business, and there was a couple different deal structures they were talking through, and she's like, Greg, I don't understand how you come up with all these different interest rates and how you come up with the different structures. And you know, it is actually a competitive situation, so there's a couple different banks, and so she's looking like, you're looking at all the same information, how come all these interest rates are different? And that got me thinking, not only from the standpoint of how can I educate entrepreneurs about how interest rates are derived on your business loans, but more importantly, what can you do as an entrepreneur in order to lower that interest rate? Because obviously in the competitive environment, in any type of environment, anytime that you can lower your costs, even if it's your cost of borrowing, then that makes your business more profitable. That puts money in your back pocket and helps you to achieve your strategic goals. So at a high level, and let me just kind of first off say that not every bank operates this way, and I'm not sharing any bank secrets or anything like that, but these are just some really, really high principles that the banks look at as they price commercial loans. Sometimes these apply, sometimes they don't. But in general, there's 5 areas that banks look at when they're determining what the interest rate is going to be on your loan. The first one is talking about risk. And this shouldn't be any surprise if anyone's followed me for any length of time, because I can constantly say at the end of a day, the bank is a risk management organization. And we're talking about all different types of risk. But let's kind of talk, let's back up for just a second. Let's talk how risk applies to your loan and your interest rate. Well, there's really 2 different types of rates that you can have. You can have a variable rate, mostly on lines of credit, but you can have loans that have variable interest rate. You know, variable interest rates have been at lows for a long time, and so a lot of borrowers are taking that interest rate risk and keeping it variable to keep the cost down. Or you've got fixed rates where the bank says, okay, your rate is going to be this much for this specific amount of time. And when it comes down to it, understanding how your interest rate is determined, it's a little bit different, but the same principles apply for both. If you have a variable rate loan, the difference is going to be the spread that is over the index. So say that you have a line of credit and you're at prime plus 2%. Well, the bank looks at everything and says, okay, for the risk of this relationship, this structure, this deal, we're going to have prime plus 2%. Other loans, other businesses that may be more risky might be at prime plus 4%, or businesses that are less risky could be at prime minus 1% maybe. So that in a variable rate world, we're talking really about that spread that's in between the index and what your rate is. In a fixed rate world, it's a little bit easier. It's just, okay, is this a 4.25% loan, or is this a 5.25% loan, or is it a 3.25% loan fixed for that certain amount of time? But the second thing that when we talk about risk is the actual risk of your business. And in every business that whenever a bank looks at, underwrites or analyzes, understands the risk that's associated in your business, they give your business, they give you what's called a risk grade. And if you don't know what your risk grade is, if you don't know how the bank looks at your business as far as a riskiness on the risky scale, then talk to your banker. Ask them. You know, this is your information, and you should be empowered to be able to understand how your partner sees your business. You should, and so I would ask your banker, what is the risk grade and what can be done to improve it? Because obviously it makes sense. The riskier business, the more the bank is going to want to be compensated for the loans or for the money that it lends out. For the less risky business, the less that it can ask to be compensated for that. So just like in your business, you've got risk and reward. The bank has the same way. So as you go in, what really goes into your risk rating? And there's a couple different things. I like to boil it down to three big things in the risk underwriting or analysis. First is your ability to pay the loan back. The banks, contrary to what you may believe or whatever, but banks aren't in the real estate business. They're not in the car business. They're not in the account receivable collection business. They will take collateral for your loan, but they would much rather have you pay that back. And so when they sit there and they analyze your business, they want to understand your ability to pay the loan back. The next thing that they look at is your leverage of the company. When you look at your balance sheet, and not to nerd out too much, but when you look at your balance sheet, you've got your assets and you've got your liabilities. And the bank looks and says, okay, well, how much of those assets do you actually own free and clear? If you have a $1 million building, but you owe the bank $950,000 on it, well, then you really don't own a whole lot of that building. The vast majority of that asset is being acquired through debt, through somebody else's financial strength. Same thing applies if you have a lot of accounts receivable. Say you've got $2 million in accounts receivable, but if you have $1.5 million of accounts payable, then what you've done is that you've borrowed money from suppliers at $1.5 million, and you've turned those supplies into accounts receivable at the $2 million mark. So you really don't have that much. Converse that with someone that has $2 million of receivables, but they've already paid for everything. So there's zero accounts payable. So that understanding the leverage is really important. The third thing is, when they look at it, is the liquidity, your cash. Say cash is king and cash flow is queen. But with cash being king, it talks about the flexibility. How do you have the flexibility in order to deal with a COVID-19, a world pandemic, or deal with a supplier issue, or deal with a customer issue? Whatever that cash that you've got on hand, to be able to shift and pivot and has that financial flexibility, all of that goes into understanding your risk rating. Understanding your cash flow is another thing that is not necessarily one of the big three, but is another thing that they look at. Is your cash flow, is it smooth and consistent? Do you have the same amount of revenue and the same amount of profitability every single month? Or just some months you have $1 million in revenue, and the following month you've got $100,000 in revenue, followed by a $5 million month, followed by a $50,000 month. What is that? What is the cyclicality within that cash flow? What is the volatility that you've got kind of bouncing up and down, bouncing back and forth? Another thing that they look at when they talk about the risk is, what are you going to use the funds for? Is this going to be something that actually helps you improve and helps you generate more profit, or is it something that you just need to borrow money because you had a difficult time and it's been a rough quarter? It's been a rough year for a lot of entrepreneurs. But what are you actually going to use the money for? Because how you're going to use that money, if you're going to use it to invest into your business and to be able to generate more revenue, more importantly, if you're going to be able to generate more profit, then that's a lot riskier of a business than if you're going to try and say start a new venture or buy a piece of equipment that you think is going to generate some revenue, some profit. It's really understanding what you're using it for. And then finally, when we're talking about risk, it's the collateral type. What are you looking at? Looking to purchase. Like I said, lines of credit sometimes fund accounts receivable. Depending on the types of accounts receivable, depends upon the concentration in the accounts receivable. That really, depending on if it's progress billing or not, that's within that one collateral type. Those are some variations, and different variations have different risk. If you're buying a piece of equipment, is it a very specialized piece of equipment? Again, banks aren't in the real estate repossession or equipment repossession business, but they have to protect their risk. And so if you're going to go buy a piece of equipment and you're using that piece of equipment as collateral, then if it's a very specialized piece of equipment, that's a little bit more risky than not. Same goes for real estate. What type of real estate is it? Where is it located? You know, how much money are you putting into the deal? So a lot of these things kind of go into, you know, understanding the risk and everything that's associated with it. And so by doing that, you can understand what it is. The second thing that talks about is that impacts and determines your interest rate is the deal structure. You know, so if you want to fix in your interest, say you want to fix it in for a 10-year period, well, that's obviously going to be a higher interest rate than if you're fixing it in for a 5-year period, because the probability during 10 years of interest rates going up is a lot higher than the probability of interest rates going up over the next 5 years. So if you want to sit there and you want to get the absolute rock bottom interest rate, then consider having a shorter period of time. Now, on the flip side, that the other side of the coin, that means is that you, the entrepreneur, are accepting interest rate risk. So if you buy a building and say you're going to amortize, you're going to pay it off over 20 years. All right, well, you can get a 5-year loan, and let's say that's at 4%. I don't know, but let's just say it's at 4%. You say, well, Greg, I think interest rates are going to go up in 5 years. They're going to be a lot higher than they are now. I want you to lock it in for 10 years. Okay, great. Well, your 10-year rate is 4.75. Because again, the probability of the interest rates going up over a 10-year period is much greater than they are over a 5-year period. Looking at maybe the deal structure, depending on how much fees or origination fees you're paid. You know, I've got some clients that they say, Greg, I don't want to pay any origination fee at all. Well, I understand that, and you have to understand, or you should understand, that that's part of how the bank makes money, is the fees that's associated with their loans, and also the interest that they get from their loans. So if you don't want to pay any fees, then you may pay for it in a higher interest rate. You may pay for, you know, you might actually be able to do the math and be like, okay, you know what, I'll pay a higher fee up front, but I want you to lower my interest rate by 1/4 point over that 10 years. So at the end of the day, you're actually coming out net, you're coming out less expensive. Understanding what that is, and understanding that a bank has to make money, understanding that the bank has to be profitable. That's just, I mean, they're just like you in your business, and you want your bank to be profitable because you want to have a relationship with your banker for the long term. Another thing to talk about would be, we talked about the amortization. So again, if let's say that you're going to buy a piece of real estate and you've got two options. You can pay it off in over 10 years, or you can pay it off over 20 years. Well, if you pay it off over 10 years, every single month, more principal is going towards the repayment of that loan. And so it's a much less risky proposition, a less risky structure for the bank. So you will probably be able to get a lower interest rate for that type of deal versus a loan that's paid back over 20 years. Again, it's all about understanding the risk that's not only in the deal, but in the structure. The last option or potential structure that might impact what your interest rate is if you have a personal guarantee or not. And I have some entrepreneurs that I work with that just absolutely flat out refuse to provide a personal guarantee for their loans. And so with this, they have to do some different things. It's a different structure. They may have to put in a lot more cash in order to buy some equipment or to buy a piece of property than traditionally. And so it's a matter of do you have that cash on hand? Are you willing to invest it? You know, what is the benefit of that? And if you have one loan, compared apples to apples, that has a personal guarantee and one loan that does not have a personal guarantee, then I would anticipate that probably the one without a personal guarantee, because that's more riskier to the bank, would have a higher interest rate. So it's a matter of kind of looking and understanding how to do that. The third thing, I alluded to this a little bit earlier, is the profitability targets of the bank. At the end of the day, the bank has to make money. The bank has to be profitable. And so just like you, whenever you invest some of your assets, whether that be your people or your equipment or whatever it is, you have to track that, and you want to make sure that you've got a proper return on those assets. And banks are the same way. They have the same thing. They say, okay, well, if I were to give $1 million loan, everything else being equal, if I was going to give $1 million loan and I was going to get a 1% return on this loan or a 3% return on this loan, well, I would prefer to have the 3% return in order to maximize my return on assets. And so every bank has a target with that. So understanding what that is. But it's the thing about working with your bank and your banker is that it's not necessarily just about a single loan. You know, if you have multiple loans, if you've got if you have a big relationship, maybe you've got all your deposits with them. Maybe the bank makes money through their credit card processing or through their treasury management. So the fees that are associated with that, I know that entrepreneurs don't like to pay fees, but it goes down to what is the value that you're receiving from that service, from that fee. And if you're receiving value from it, then that's generating revenue for your bank. So the bank, your relationship is more profitable to the business than not, or than not having that. And so because of your relationship, you might be able to say, okay, you know, the loan I'm making a very, very thin margin on, or I'm making almost no money on that. But because of X, Y, and Z, because we have a deeper relationship, I'm able to offer you a lower interest rate on that. So understanding what it is. And I also understand that entrepreneurs don't like to necessarily have all their financial eggs in one basket. I completely understand that. But you just have to know that a potential offset of that is a slightly higher interest rate. And then that's where you sit there and you determine, okay, is this slightly higher interest rate, or is this higher interest rate that I'm paying, is it worth the risk of not having all my financial eggs in one basket? You know, completely up to you. The next thing, the fourth thing, is just how banks operate. You know, and different banks have different things. You know, from efficiency standpoint, I think sometimes banks might have what I call like a sheet rate or a deal rate that says, okay, for this type of client with this credit score, buying this piece of equipment, this type of equipment, at 85% loan to value or 80% loan to value, here's your interest rate. And so instead of kind of doing all the deep dive analysis and everything, they just say, here it is. And then based upon your relationship, or based upon your risk profile, that sheet rate may go up, it may go down. So, but it's a way, it's kind of a starting point to understand where that is. Another thing that it talks about specifically about operations, depending upon the type of loan, and what I have in mind here are SBA guaranteed loans. So if you've ever had an SBA guaranteed loan, you know that at the very beginning, every loan or every line of credit, there is an SBA fee that is used in order to help run the program, but then also create a pool of money that if in the event that the loan goes bad, that money is set aside in order to pay the banks back for the use of the SBA guarantee. But what and from there on out, you cannot get charged any fees with SBA loans. Now, the one exception is the SBA 504, but I don't want to kind of go down that rabbit trail. But for a standard SBA 7A or express loan, there's no other fees. So you might have a line of credit that renews every year for 7 years, and there's no annual modification fee. However, you may or may not know this, but the SBA actually charges the bank a certain fee every single year for SBA term notes and SBA lines of credit. And so because of that, because the bank is receiving, there's a cost, an ongoing cost to the bank. Maybe the bank, because the bank can't charge you an origination fee for an SBA loan, but maybe that bank increases the interest rate by a certain percentage. Maybe it's 10 basis points or 25 basis points or 50 basis points, depending upon the bank, in order to say, look, this is a fee that's passed on to us through the SBA, and so we're going to charge you a higher interest rate in order to make sure that we can pass that on to you, the person who has the loan. And the fifth thing that banks look at as they're trying to determine what the interest rate charged to you, the entrepreneur, is the market. Is it a very competitive market? Because if it's a very competitive market, they may have their own internal metrics and risk assessment and return on asset projections and thresholds and all that. But if the market is saying, no, this type of loan, or this is a really, really high publicity type loan, the bank may say, you know what, I understand it's not necessarily hitting all of these other metrics, but because of the exposure, because of the market that's out there, we're going to have to be competitive and we're going to have to win. So understanding what that is. So all that's great, and understand, again, knowing that risk, deal structure, profitability target, bank operations, and the market all play into how your interest rate is determined. That's all great, but Greg, what does that mean to me? So how can I, if I were you, I'd ask me, okay, Greg, how can I as the entrepreneur actually influence and impact and lower my interest rate? And so I want to kind of talk a couple of things through that. So first off, you need to know your numbers. You need to understand the cash flow of your business. You need to understand the profitability of your business, and find ways to increase that profitability. Find ways to be able to say, okay, how can I make this a less risky deal for the bank and for me? Perhaps that's looking and saying, okay, I'm gonna start working with customers that are more profitable. Therefore, my cash flow is more consistent. It's not erratic, but my profitability is stronger. Maybe that's you're coming in and saying, look, I want to be able to get a better interest rate risk, and so it's worth me putting in an additional 5, 10, 15% down in cash equity into the deal in order to lower that loan to value. And by doing that, it makes it a less risky deal for the bank, and then you're rewarded for that by having a lower interest rate. Maybe you're going to sit there and you're going to stockpile your cash and have a strong amount of cash on hand, and to be able to say, how can I look and make sure that my business is able to withstand any hiccups or any changes or any unknowns? Well, having cash on hand, either in the business or in you personally, that de-risks it, and so that helps. And then understanding, like we talked about, the consistent cash flow, understanding, my business may have some erratic cash flows, different high months and low months. So what are you going to do in order to change that, in order to be more consistent, and again, make it willing to be a lower deal? So another thing is to, like we talked about, leverage your relationship. If a banker says, well, look, I want to be a relationship banker, I want to know you, I want to help your business, and I want to be able to prove my value in all aspects of our relationship. Good, great. Well, that's a two-way street. If you are working with the banker and they have all your deposits, and they do the credit card processing, and they have your credit cards, they have all these different products and services where you're actually paying fees for value, but you're paying fees, well, then be like, look, I'm sure that you consider this, but take a hard look at all that my business has brought to you and your bank as far as revenue and profitability, and make sure you're giving me credit for that. And just kind of walking through it. Or if you've been resistant to either looking at moving some of those services over to your bank, then be open and willing to be able to try that. Because again, if the bank is making more money in other aspects of your relationship, then maybe this is an area that they can lower your interest rate and lower the cost to you. The third thing is that I would say is to change your mentality. And what I mean by that is when you're sitting there and you're looking at a loan proposal, look at the whole part of the deal structure, and realizing interest rate and the cost of money is a very important part of it, but it's not the only part of it. Look at it from the lens of which structure, which bank is offering me the most financial flexibility. For instance, if one bank is only offering you a 5-year fully amortizing loan at a low interest rate, well, that's really good. But then if you've got another bank that's offering you a 10-year loan fixed for 5 years, so you are kind of comparing apples to apples, but the interest rate is higher. But what you get in exchange for that interest rate is a little bit of financial flexibility. Now, on the flip side of that, you sit there and you look at it and be like, okay, yeah, it's a little bit higher, and I bear some interest rate risk in 5 years. But again, what structure helps me to be the most financially flexible and to be able to do that? You know, that's not only in interest rate, but I'm talking about the amortization, the term, the amount of time that is locked in, having a prepayment penalty or not having a prepayment penalty, having a personal guarantee, etc. You know, looking at the different types of structure, change your mentality and how you look at the structure and find out which structure helps you from a financial flexibility standpoint, not necessarily just a cost of money, not just the interest rate. And then look at it and say, okay, well, what is this as far as looking at my entire relationship? What is the value that I get for the entire relationship? It's not only through products and services, but it's also through understanding the relationship that the banker gives you. Do they talk to you? Are they proving themselves to be a trusted advisor? Are they proving themselves to be someone that gives you good advice and actively pushes you towards success, not just coming back at, you know, once a year, taking you out to lunch, slapping you on the back, maybe going to play some golf or whatever, you know, going to see a football game or something like that, but someone that actively is working for your benefit and knows what your strategic goals are and then pushes you towards that. And then the last thing that I would do, the fourth thing that I think you can do in order to help understand and help lower your interest rate is just talk to your banker. You know, again, I'm a huge proponent of your banker is sitting there. He is or she is someone that should understand your business intimately and someone that should understand the risks that are in your business. And so ask them, what are the things that are in this deal, or what are the things that are in my business that makes this a more risky business to the bank? What can I do in order to lower my interest rate costs? You know, again, put it on the banker to be proactive, to be able to help you and have a plan, a 1 year, 3 year, 5 year plan of what it takes to lower your rate in order for every dollar that you save in interest cost, that's a dollar that you can put in your back pocket as profit, or that you can build a strategic reserve, or you can invest in your business. But that's you making the determination of where that money goes, not your banker. So I've always said that being an entrepreneur is one of the most risky things that you can do. But I also believe that entrepreneurship, especially entrepreneurship today, is a team sport. And so to be able to go out and to challenge your banker and to be able to say, okay, how can you come alongside me? How can you come around me? And how can you push me towards success? That's the important thing. I hope that this was a meaningful, I hope this was valuable content. I hope that you understood kind of where I'm coming from. Again, this isn't for every specific bank. Every bank handles a little bit differently, but this is very high level of how banks look at interest rate, and more importantly, how you can impact your interest rate. If we're not connected, I would love to connect on LinkedIn, Facebook. I'm trying to start Instagram up, so I'd love to connect with you there. I'd love to be able to learn how I can support and encourage you. And so until next time, this is Greg Martin, the Entrepreneur's Banker. Thanks, and have a great day.